You open an envelope from the IRS and it says your records weren't adequate. This is IRS Letter 979. Your stomach dropped, you're picturing agents at the door, and your bank account drained by Friday. Take a breath. After 32 years of doing this, I can tell you that Letter 979 is not the monster that it looks like. But it is a warning shot, and how you answer it definitely matters. Here's the part most people miss. Letter 979 is not a bill. It's not a levy. Nobody is seizing anything. It shows up after an audit. The examiner looked at your business return, asked for the records behind your numbers, and decided that what you handed over wasn't enough to prove your income or your deductions, so they couldn't verify the return from your paperwork. The letter does two things. It tells you that your record keeping fell short, and it tells you how to fix it, and asks you to put it in writing how you fixed it. That's the whole letter. They're putting you on notice, not putting you out of business. So why you? Usually it's not fraud, and it's not some red flag that you tripped on purpose. It's that your books didn't hold up under a flashlight. Maybe you ran income through a personal account and a business account, and nobody could tell which was which. Maybe your deductions were real, but the receipts were gone. Maybe everything lived in a shoebox and a memory. Here's the truth. The IRS doesn't need you to be perfect. They need you to be able to prove what you put on that return. When you can't, that gap is what triggers Letter 979. Now let's talk about what they're entitled to expect, because this isn't the IRS making up rules as they go. The tax code requires every business to keep records good enough to show its income and back up its deductions. That means your income records that match your deposits, expense records with receipts and invoice tied to actual transactions, mileage logs, payroll records, a real set of books, not a guess at year end. When the examiner says inadequate, that's the standard you missed, not artistry, not a CPA's gold star, just records that prove your numbers. Now, some of you have heard that there's a rule that lets you estimate when your records are gone. There is. It's called the Cohan rule, and it comes out of a case from 1930 involving a Broadway producer who kept terrible books. Now, here's the part that the internet won't tell you. Don't count on it. The Cohan rule only helps you if you can first prove that you actually spent the money, and even then, the court hands you the smallest number it can justify. Worse, it doesn't apply at all to expenses people lean on the most: travel, meals, entertainment, business gifts, and listed property like your vehicle, your computer, your cell phone. For those, the law demands strict substantiation. No receipts, no deductions. Estimates won't save you. So if your plan for Letter 979 is I'll just estimate it later, that plan has a hole in it. And here's where people actually get hurt, not from 979 itself, but from ignoring it. If you sit on this letter and do nothing, the next thing in your mailbox is Letter 1022. That's the follow-up, and it's not patient. It gives you 15 days to explain how you've corrected your bookkeeping. Blow past that deadline and the tone changes. Now you're looking at more audits, adjusted liability on the return they couldn't verify, and penalty stacking on top. There's an accuracy penalty for negligence that runs 20% of the understatement of tax plus interest that doesn't stop. A paperwork problem becomes a money problem, and it didn't have to. So let's talk about doing it right. When you respond, you don't just say, I'll do better. Anybody can say that, and the IRS has heard it 10,000 times. You show them a system. That means real accounting software with a proper chart of accounts, a clean separation between business and personal money, receipts matched to transactions, a bookkeeping process you actually follow monthly, not a frantic reconstruction at year end. If you brought in a bookkeeper or a new firm, you just say so. The message you want the examiner to walk away with is simple. The gap that triggered the letter is closed, and it's not coming back. You put that in writing, you back it up, and you do it before the deadline. And in writing matters. A phone call you can't prove later is worth nothing. Let me save you some pain with the mistakes I see the most. One, ignoring it because it doesn't demand money. The clock is running whether you read the letter or not. 2, getting defensive and arguing the audit instead of answering the actual question, which is about your records going forward. And 3, going it alone when the underlying audit is still alive. The wrong answer here can reopen your books and invite them right back in. Now the good news, and there is real good news. By itself, Letter 979 doesn't cost you a dime. It's a chance to get clean before any of this gets expensive. Fix the records, document the fix, answer in writing before the deadline, Do those three things, and this letter goes away quietly, the way most of them do when somebody actually responds. The reality is almost always more manageable than the nightmare in your head. If you got letter 979 and you're not sure that your response will hold up, don't guess. The wrong move here is the one that turns a warning into a bill. Let's talk. I'll tell you exactly what they want to see, and we'll make sure your answer closes the door instead of opening it.